Everybody, thank you for joining the FX Open Breakfast with myself, Kathleen Brooks. We're going to get right to it. It's been a kind of a day of consolidation, really. There's not been too much movement so far during the Asia session, which really took its cue from the US and Europe yesterday. So, what we've seen is kind of a mixed-ish start to the day at the European Open. Things slightly down just a touch, but really still holding on to those gains that we've seen over the last couple of days. A big change from that very sharp sell-off that we saw on Monday. Now let's go straight and take a look at the charts. Just bear with me one moment while I pull them up. It does seem, bear with me one moment, sorry. It does seem rather strange, actually, that we've been, not that, it wasn't, it wasn't that long ago. It was, this time 2 days ago, so 48 hours ago, that we were, looking at a break below 130 in euro dollar. Well, as you can see here, I'm just going to double check with FX Street Admin that you can see my chart here. It's a euro dollar 60-minute chart. Bear with me one moment. Oh, brilliant. It looks like people can, which is great. There have been a few, things to note. Obviously, it seems to be very much kind of consolidation phase at the moment. Again, kind of that 132 level really has thwarted the bulls. We've seen the high today of 131.40. Yesterday that was 131.70. We're around this 131 level. As you can see, testing a bit of support here now at 131.10. But what is the overall picture showing? We do think that potentially this move to 130 could potentially be a medium-term bottom. If we look at the daily chart, we'll take a look at that. That was a very long shadow here, you can see, and then kind of a bounce back, which suggests a potential reversal. Also, just draw your attention to the daily RSI. That is also pointing higher. Obviously on the upside now, the focus is very much that 132 level. So 131 kind of 19 to 132.15. That also encompasses this area of resistance here. So as you can see, very, very tight range, which is interesting. Obviously, sometimes as ranges get tight, it doesn't necessarily mean that we're going to stay there. I'd also just draw your attention to this potential kind of triangle formation here. What we have actually been seeing is that, we tested below, kind of below this support line in this triangle and moving high. But basically, this triangle pattern is a consolidation pattern. And it does suggest that we could potentially move higher. Now, obviously, we've got this dip resistance zone between 131.90 and 132.20. And then above there, obviously, kind of moving to the 133 zone. And then above there, we could potentially then target 135. But it is interesting. We would say that, anything with a long shadow, when you see a long shadow and then the body changes direction, like we saw on Monday. So what this candlestick shows is basically, in fact, let me just see if I can expand the space between bars. Hopefully you can still see that. But as you can see here, I've just expanded the space between the bars. It's exactly the same chart. But as you can see here, we did test this resistance. We did test this support line here, and dipped below 130, obviously, as on Monday. However, the fact that we've got kind of a long shadow, but then a close above there suggests that the bulls really got the dominance there. So the bulls came in, they bought at that level, they bought on the low, and that helped it kind of bounce higher. Bit of a doji yesterday. We didn't see too much action. The open and the close very much at the same level, suggests indecision in the market on a daily basis. So indecision for the more kind of longer term trader. And then of course today we've opened down slightly. We're currently testing that 131 zone. Interesting. It could just be always whenever I kind of speak to clients or whatever else, that 8 o'clock to 8:30 time zone in the UK can be very, very volatile for currencies, because you get a lot of these fixes, what people call fixes, going through. So these are big chunks of orders that banks may have, potentially from some sovereign buyers, supranational buyers, and that tends to go through at 8 o'clock. So often the 8 o'clock fix isn't really, 8 o'clock's not necessarily the best time. So the European stock market open is not always the best time to see what's going on, what the direction in the market really is. And it's sometimes better to wait till about 8:30, maybe 9 o'clock, so like about half an hour into the session, to really get a sign of what's going on. I mean, how many people have been, trading immediately at the open, and then, only for it to kind of go wrong because of mix up in the fix? Well, lots of people have. But really, I mean, I would think I'm neutral on euro dollar at the moment. I think there's a couple of things that I am looking at that I'm going to take my cue from. Firstly, it's whether or not this level holds, so this 130.70 support level holds here in this triangle. The second thing that that is interesting me in this chart is that doji, that indecision. And then the third thing is the fact that we did test below 130. However, we didn't like the air down there and we came back up. So it suggests that there is a lot of support around that 130 zone, as one would expect. The level is going to be supported by the market, but it's where we go from here. Does the fact that support holds at 130, does that mean that we start a new leg higher? We don't think so at the moment. We think that, again, it's kind of a tightish range, but anything above 132 suggests that we could march higher. So right now it's kind of between 130.70 and 132.20 is the range that we're targeting. So, any kind of move towards 130.70 we think could be picked up on the bid. So do watch out for that. 130.95 has been the low today, so we're testing around the lows right now. Do watch that. Obviously, if we are to get below there, 130.50, 130.30, and then obviously 130. If we get below 130, 129.70 is the first level of support. But what I'm trying to explain, not just throw numbers at you there, just really try and show you the fact that there is an awful lot of support on the way down. Likewise, there is on the way up as well. This 132 level is is a really significant resistance zone, but on the way down there really is. The 130.50 is the bottom of the Ichimoku cloud. The 130.30 is the H&S neckline. So just draw that kind of around that level, around just up a tad. Let me just get rid of that other line. It's a bit confusing. And then, of course, 130 is just such a key psychological level. So do watch out for that. Obviously, we don't think we're going to go from one situation to the other or break out of this range until we get some sort of external event. So maybe some fundamental factor. So you've got to mix your fundamentals with your technicals today. Someone's just said they're watching the Spanish bond yield to get a good direction of the euro. That is such a fantastic thing to do. Well done, because that is a really good way of looking at that. In fact, on that note, I'm going to just pull up my other chart, and we're going to take a quick look at that. Bear with me one moment. I'm just going to pull up that chart, the Spanish 10-year chart. As you can see here, this is a 10-year bond yield. It's been a bit all over the place, a bit volatile, a bit of indecision up here, but it still remains at elevated levels. And you could really, that's kind of tracking, euro dollar pretty closely. Euro dollar has been at its lows, and is at its lows, or kind of weak within its range, but it's not yet gone past critical territory. So it's not yet gone through. We haven't had a collapse in the same way that we haven't had, Spanish bond yields very much moving in the wrong direction, but we haven't had that surge like what we saw in November. This is a bond yield for Spain. So this is the Spanish 10-year bond yield. Now, the other thing I want to show you, those of you who've been joining these webinars for a long time now, will know that there's also another way of looking at the yield curve, which really highlights stress in the bond market. And that is the spread. So it's a spread between, so it's 10-year bond yields minus 2-year bond yields. And why we look at that is because in a healthy environment, you tend to see, in a healthy environment, you see longer-term bond yields rise above shorter-term bond yields. That's healthy. That's what should happen. And so you should see the bond spread move from left to right, move higher left to right. What we've seen, obviously, there have been times when that hasn't been the case. Sometimes it gets impacted by what's gone on in with interest rates. We may have short-term interest rates being hiked as we had in 2004. That caused the spread to kind of narrow, the spread to narrow somewhat. But that was done in a very kind of gradual manner. What wasn't very gradual was this sharp move at the end of last year. So we saw 2-year bond yields really sharply move above 10-year bond yields, and that was all credit risk, really. And essentially, if people are unwilling to buy your short-term debt because they think you won't pay that back, that's when your longer-term bond yields are going to be rising. Your shorter-term bond yields will be rising at a faster pace than your longer-term bond yields, and that suggests real credit fears, real sovereign debt stress. And so what we've seen here is this spread start to narrow a little bit. So that means that the 2-year at the moment is outpacing the 10-year. We're not in danger territory right now, but I think it is worth watching. I mean, that is quite a sharp turnaround, and we've seen that before, and that was when there was panic. The other thing I want to show you is just, what's been the trigger for kind of breaking out of ranges, the trigger for maybe central banks easing the situation, causing a bit of a rally. A lot of it comes down to volatility. And I am going to show you a great way to measure the volatility, or a great in my view. And here we go. You should be able to see it now. This is a 4-month Eurodollar at the money option, and it's the volatility within that option. As you can see, very, very depressed. Why is that? This kind of, if we just track what's it done over the last 12 months. Well, it reached a real high in September, October as volatility spiked, as sovereign debt fears really caused concern in the market. It then came off very, very sharply when the ECB came in with their LTRO bond auction. Since then, had a few spikes higher, but we've since retreated. So what it suggests to us is that volatility is quite low, which suggests that we're going to have to see another, how do I put it, in a more elegant way, we're going to have to see the market freak out a little bit, I think, before we're going to see any soothing words from the ECB or some solid action from the ECB or the EU authorities. Obviously, we have got that IMF G20 meeting today. That is going to be, sorry, not today, this weekend. I do apologise. That's coming up this weekend. Of course, they could always boost the firewall, but it's unlikely they're going to boost it to a size that's important enough. But, I would just point that out, that there's right now no signs of stress, really, or volatility is showing no signs of stress. And we've tended to see central banks act to solve this crisis only during bouts of volatility. So it's certainly worth looking at this. Now, it's not that easy to find, but it is written about. We do monitor it, so it is worth kind of pointing that. So it is kind of keeping that in mind. Okay, we're going to leave the euro for now and take a look at the pound. Just bear with me while I change my chart. Okay, that's still the euro, but we'll go into the pound now. The pound has been, oh, sorry about that. One moment. The pound has been kind of an interesting one. This is the daily chart, and let me just push that back together. Oh, no, wrong way. Sorry. Oh, sorry. There we go. This is the daily chart, and as you can see, talk about consolidation mode. I mean, this is the daily chart. Look at the RSI flatlining. Let's go to the hourly, see what's going on there. We have seen a bit of weakness. The pound has been giving back some gains. It's still very much in consolidation mode, with 159.50 being the upside, 158.50, and then 158 on the downside to watch. There is obviously this key resistance zone between kind of 159.50 to 60 and 160.10. That is going to be the main that is kind of a really key resistance zone. And then we believe that if we were to get below 158.10, that could potentially show us that could potentially suggest a weaker move downwards. Now, someone's just said and pointed out that at 9:30 we could get some volatility in the pound. We could do, certainly. There is labour market data, and of course those minutes from the Bank of England released at 9:30. Interestingly, I think the labour market data is obviously backward-looking, but that is important, and we know that if that deteriorates, it could take the wind out of the sails of the pound. The same going for the minutes. Now, the minutes of the last MPC meeting expected to show another split, with two people calling for more QE. We think that it's not going to change from the March meeting. That just the same two people voted for more QE. However, we would note that the inflation data yesterday was slightly on the upside. That caused this big spike higher as investors price out the expectation of more QE. But what it's really shown to us, the fact that we haven't been able to keep those gains kind of at 159.65 suggests to us a new resistance has been put in place. But that doesn't necessarily mean that we're kind of we've turned about. We're just still this whole pattern is consolidation phase. Obviously, on the short term, the RSI has pointed lower. We're not into oversold territory, so there could be a bit more weakness to come, maybe back down to that 158.50 or 158.65 to 50 level. So do watch out for that. Obviously, if we would get three people, say a 3-6 split at the Bank of England in those minutes, which are released at 9:30, we think that would be incredibly pound negative. So do watch out for that. We could see the pound really react to that on a short-term basis. But it really is, when trading the pound using UK economic data or UK central bank action, it's a short-term game because the pound has been very immune to what's been going on recently with the domestic economy, and is very much, especially cable, it's being moved about by risk aversion, by overall kind of dollar moves, and of course that's going to have a big impact on it. So important to watch there. I also do want to show you euro pound, because euro pound is how we prefer to go long the pound. So if we, for example, if we get it's basically how we like to go long the pound, and you can see that here. Obviously, it's been euro pound has been very, very weak. It certainly wasn't helped by that stronger inflation data in the UK yesterday, which just made QE, which is traditionally seen to be bad for a currency. So the fact that it kind of priced out a bit of QE was pound positive. Again, as I said, because the dollar is used as a safe haven, we really do prefer to trade the pound against weaker currencies, and we think right now that the euro is still weaker than the pound. Again, we said to buy it on pullbacks, and we still kind of advocate that. We're currently around the 82.30 level. Any kind of pullback towards that 82.50 level could be a very good buying area. But as you can see, we are at a significant low here, so we are a bit concerned about piling in right now. We'd rather sell on any strength, and you can really see that when you go all the way back to, this is the weekly chart. It's kind of this is the low going all the way back to kind of 2010, so it's a really important level. That 82 zone is massively important. If we get below 82.10, we think that opens the way to 81.40, which was the low in 2010. So do watch out for that level though. And obviously, if we were to see a big escalation in fears in Spain, obviously tomorrow Spain goes and auctions its long-term debt. That could be very euro negative if something happens there, and then we could see euro pound go through that 82 level. So do watch out for that. Okay, someone's asked me to look at gold, and I'll happily do that. Gold has been interesting. I'm going to look at two charts of gold. The first one being just this, my Forex chart. So this is the weekly chart. I didn't even mean to look at this one, but it just happened to be on the weekly indicator. It kind of just shows you on a long-term basis how well gold has been doing, but just how long this consolidation phase has been lasting. It also suggests that we are kind of at a bit of an important level, and that maybe below 1600 suggests a bit of a deeper pullback. Okay, let's take a look at the daily chart. So as you can see, smack bang in the middle of its range. We did point out last week that we had seen gold really rally for a couple of weeks there, even when the overall risk environment wasn't very positive. Wondered what that was all about. Whether or not that was a sign that gold was coming back to be a safe haven. Lo and behold, it wasn't. It got thwarted at this kind of tweezer top here at this kind of 1680 level. That has been the high for now. So before we got to that key 1700 level, and it caused kind of another leg lower. One thing I would point out on the daily chart, I'm a little bit concerned at these series of 1, 2, 3, 4 lower highs. Suggest to me that we're obviously in a consolidation phase, but we're testing support. If we do break below this kind of 1650 level, it does open the way to 1600. So gold is looking very vulnerable in my mind. Gold is going to be moving with, gold hasn't really been moving with risk appetite either. And that's the other thing to point out. Not in the short term anyway. Over the last 2 years it has been, but it's tended to kind of preempt moves. So last week we saw this push higher, or the last couple of weeks we saw a push higher in gold. Some people thought, well, gold's now back to being a safe haven. Well, no, it wasn't. It looks like, to me, people were piling into gold because they were on the expectations that central banks would never allow Spain to get into trouble, that the ECB will step in at some point. So they got in there first. People kind of diversified into gold, but then what we've seen is kind of gold kind of fade off a bit. So gold is obviously gets hit by losses elsewhere. So if people are losing money on their sovereign bonds or on their stock positions, maybe their stocks of European banks, they're going to sell gold. Likewise, banks and countries themselves are big holders of gold. So if they get into trouble, gold gets sold because they can sell it. But that also has a big impact on how gold performs generally. So what we've seen here is gold really kind of, it's breaking away slightly from other asset classes. It's kind of consolidating, but it is looking particularly vulnerable, especially if we break through this 1640 level. It definitely opens the way to 1600, and then below there to that 1550 lows from the start of the year. So, gold is telling us really all is not well in the world, and that there's some expectation potentially of further weakness. Maybe an overall risk market, especially if it is a lead indicator, if it is acting as a lead indicator. We don't know for sure yet, but it rallied before the rest of risk assets. So it rallied last week and the week before, and when risky assets like stocks are doing badly, it hasn't. But then that rally is fizzled out now. So maybe that's something to watch as a safe haven, as a lead indicator. And I say that based on the fact that sometimes people do pile into gold or out of gold first before they kind of make moves elsewhere. So do watch out for that. I think gold is looking pretty vulnerable. I just want to show you as well the Ichimoku cloud there. Just bear with me. So as you can see here, this is the Ichimoku gold, the chart for gold. Gold is below the cloud again after having been above it, so above that 1680 level. Didn't really last there. That's that tweezer top. and since then it's kind of fallen. There is a bit of support at this 1650 level, but again, if we get below there, as I said, 1600 does look vulnerable. So a bit of congestion, a bit of stickiness, but no convincing break into the cloud, which suggests that there could be more weakness to come in gold. So that's just kind of an important one there to watch. And then I'm happy to take a couple of questions if someone wants to look at something. I've probably got time for one more chart if someone has a burning idea. Otherwise, I'll take a look at Aussie. So if anyone has something they want me to look at, do let me know right now. Let's just, Aussie. Let's take a look at Aussie then. Haven't looked at that one. We haven't looked at that one for a while. Aussie has been, I'll take a look at Aussie and CAD. So Aussie still very much within its range. This is the daily chart. As you can see, up and down, finding a bit of support here at this 103.70 level. Again, 104, this tweezer top here, so this kind of 104.65. Oh, sorry, no chart. 104.65 has been the high for now, which is that tweezer top here. But good support is kind of 103.70. So again, it's looking vulnerable. A break below kind of 103.50 would open the way to 102.20, we believe, which kind of is the lows from earlier this month. So again, not really telling us anything. Still have this series of lower highs, which again suggests to us that the downtrend is still intact. A little bit of consolidation going on here, but pretty much still a downtrend, we believe. This could just be kind of a bear flag going on, and so we're going to look at that. Now, the other thing I want to show you is the CAD, because we had the Bank of Canada kept interest rates on hold yesterday, but their statement suggested they were slightly hawkish. Added to that, we also have today the monetary policy report from the Bank of Canada. So it's the Bank of Canada. So that comes out. Just bear with me one moment. Yes, later today at 3:30 our time. So that would be 10:30 US time. So this is dollar CAD on an hourly basis. As you can see, really clear level of resistance there at this kind of 103 level. This kind of 103 level. Broke down pretty sharply yesterday on those hawkish comments from the Bank of Canada. Let's take a look at the hourly. So as you can see, that's all Bank of Canada. Clear rejection really of that kind of of parity. A clear sharp drop lower. Took out the critical 99.50 level. We're very, very with relative ease, as you can see here. Haven't climbed any way back near there. We're still kind of around. The support level really is this kind of 98.60 zone. 99, of course, is going to be another key resistance level. Hasn't managed to taunt it yet. We think that potentially this pair could float along around the bottom until we hear some more from the Bank of Canada. So, obviously there has been expectations the Bank of Canada may reduce stimulus before the Federal Reserve in the US, which is obviously key. What is more kind of important, what as traders, what we need to figure out is, has that already been priced in? What we really need to see is, has that already been priced in, and what does that mean? What more does the Bank of Canada need to do to really push this, to really boost the Canadian dollar? So we think that if they don't, essentially we don't really see them being any more hawkish than what they are right now, than what they've been already, than what we expect already. And we think a lot of what the monetary policy report is going to say has been priced in already. However, we would note that we think we're kind of on another kind of paradigm lower in dollar CAD. So, below 99.50, potentially with between kind of 99.50 and then a breach obviously of 98 could open the way. Let's check here. These are the recent lows. I mean, that is important. A breach of kind of 98.60 could potentially open the way to going all the way back to nearly kind of a year ago. Oh, let's get that working. So around that kind of 98.50 level. So, we have had the sharp move lower already, so that's kind of an important thing to watch. So someone's just quickly said, are the UK economic data releases, is it important? Yes, of course they're important. They really are. It's worth looking at. Definitely keep your eye out. We do want to know what their split is in the monetary policy committee. We'll get that from the minutes at 9:30. But we also do want to know what the unemployment is saying, because we've had some very good economic data in recent months, or recent weeks, sorry, I should say, out of the UK. But the unemployment data is what's real cause of concern, and if that's still moving in the wrong direction, then that could be quite negative. But however, do watch out for all of those releases. It could cause a bit of volatility in the pound later on. But as I said, watch out for the Bank of Canada as well. Any sign of hawkishness, and we could easily test that 98.50 level and get through it, and maybe even test 98. So do watch out for that. Thank you very much for joining, and I will good luck in the middle of the week, and I'll hopefully see you all on Friday. Okay, take care, everyone.